Welcome to CEO Money. I'm Michael Yorba. I have Rob Braiman, Principal Managing Member of Cogent Analytics, on the show with me today. Rob, welcome to the show.
Mike, great to be back.
All right, I'm glad you're here. All right, cash is king in business. Now, the importance of cash flow for business health, bring that out for me.
So I'm going to do something a little different with you today, Mike, although I really do want to talk about cash is king, especially for the American entrepreneur. Most often what happens to our clients is, you ask them, how they're doing, and they really measure in two ways. A, I got money in my bank, and B, I feel like my sales are growing. Now, funny enough, when your sales are growing, most often your cash position is usually shrinking. Right. So when I see a hyper growth company, and I'm sure each one of your listeners have heard the old story of the fastest way to kill a company is to grow too fast. Right.
Yeah.
You have that in your listeners, your friends. You've been in business for a long time. People manage profitability occasionally. Usually they'll manage gross margin as opposed to net margin. But I want to make a clear distinction. And we just had this very specific circumstance this week with a client who had made $250,000 of net profit this year on essentially a $4 million business. So not great, right? He was well shy of the 10 to 12% minimum mandatory profit that we would have earmarked for him in our process of discovery. But what happened is he grew from $2 million to $4 million, and his receivables had gotten longer. So his 7% profit, although he made $250,000, he was underwater with his creditors. He was underwater with his payables. In other words, his vendors who were selling him inventory to produce jobs. One of his vendors had just threatened to put the client on cash only. And the guy couldn't understand that I had made $250,000 this year, but I have nothing in my account. So we had to take him through the exercise of you had to pay for debt because you had bought equipment, you had borrowed in your form of your line of credit, your bank forced you into a position to convert your line of credit to a fixed loan on a term base. So then you had all of your vendors, and when you grew from 2 million to 4 million, your number of receivables grew. So all of your money, that profit that you made, got eaten up by having to pay for the inventory you purchased, got eaten up by servicing the debt to your bank that you had already bought additional equipment to do the job, and your money was eaten up in receivables and inventory on hand. And this particular client, his inventory alone had grown over $100,000. Right? So you can quickly see that you can wipe out $250,000. So in a year when he had not great profit, but at least reasonably good profit at $250,000, it was not enough to cover all of his obligations, which is historically one of the prime things that we do. And here's where I'm going to shift our conversation a little bit, if you allow me some latitude.
Sure.
So we're going into 2019, which I say kudos to everybody who had a successful year. I say I'm sorry for those of you out there that did not have quite the success that you expected. But the best part about owning a business, occasionally at this time of year, we sit back and we reflect on how did we do, right? Did I impact my family? Was I able to take care of my wife? Did I give myself a pay raise? Did I just pay Uncle Sam, or was there a little money left in the till that I could take in the form of a distribution? Owning a business is a wealth creation vehicle. Owning a business is about being able to follow your dreams. Owning a business is about being able to do something special in your own vision. And if I can say one thing to all the entrepreneurs out there, when times seemed challenging, when you weren't able to collect on that receivable that you needed, you didn't get that job that you expected to get bid award on, when you lost that key employee, when times are darkest, occasionally you need to sit back and you need to relish in the victories that you've had this year, because those moments of trial and tribulation, especially as you draw towards Christmas, remember I said this, please don't let your business own you. Be the president, you own the business. So if you'll allow me some social grace as we get in, I think we've done a number of these series together, Michael.
Right.
I think it's important as business owners reach the end of the year that they begin to reflect on the positives and they build a strategy. If you're not where you want to be, then there's something in your strategy that needs to be addressed. If you're doing well, don't think well is good enough. In the small business community, we have to force ourselves to be great every day, because you never know when you're going to be faced with a downturn in a market, a downturn in economics, losing of a strategic partner, a strategic relationship. So you want to relish in the good points, and you definitely want to strategically plan both to avoid some of the challenges that were created for us during the year and to better prepare us for how we're going to execute on the year going forward.
I agree 100%. You've got some insights on that point, then, and just giving us the case study about this. How would you have been able to tell your client, hey, you need to look ahead a little bit further so that you don't feel satisfied and then find yourself in a tough spot at the end of the year?
So we started an initiative of planned growth, right? The first thing we had to do was actually implement a receivable program that was healthy. It was routinated. In other words, there was an order to events on both how we were going to invoice. This particular client, the GC, wanted their invoices on the 21st. And historically, they were so busy that they wouldn't get their billing out until the 23rd or 24th. And a lot of the GCs were putting them on the bottom of the pile, and it was kicked to the next cycle. So instead of getting paid in 45 or 50 days, this particular client was carrying receivables for 68, 69, 72 days. So we had to address the receivables issue to accelerate their cash flow. We had to work with their payables and their vendors to say, you know what, this is not a lost cause. It's a great company. We're making money. We had some challenges, but we had to get to a program with their vendors that their vendors saw the light. They knew that the client had it under control, and they felt good about being paid. You can't avoid your vendors because they're your business partner. If they lose faith in you, then you have nothing. Then you end up starting paying double for a product that you should be getting at a competitive price. That ruins your margin.
Right.
Okay. Mm-hmm. The next thing we did is we put into place a very strategic growth plan, because going from $2 million to $4 million is a great success. But part of what we were seeing going from $2 million to $4 million is that their bidding and estimating was not tightened down, which means they were losing margin on some of the jobs that they were awarded. They grew too fast organizationally, and they didn't have the mid-level, they had a leadership group that sure as heck looked like they were trying to run it the same way they ran $1.5 million or $2 million company, which both you and I would agree, Mike, that that's impossible, right? You can't run a $4 million company the way you run a $2 million company.
No, you can't.
So he didn't have the right hats on the right people, right hind ends in the right chairs, although I say it usually a little different than that. Mm-hmm. And we had to address the issue of how we were producing our product in the field so that we were maximizing our gross margin. Now, we've had pretty good success in this particular area because we've almost doubled their net margin. Now, that's not an instant fix, right? But what we were able to prove to the client that within 3 months and then 6 months, we would be able to turn the story on its head. And one of the first things that we teach our clients is pre-planned distributions at the beginning of the year, right? So if you know what you intend to make, then you can plan for both how much you're going to grow, what you're going to sell, what your margin is going to be, what promotions there might be in store for your employees, how many dollars you're going to reinvest in your business, what are your government obligations, what are your debt obligations, what are your growth obligations, so that we knew that if we made these improvements, that the business owner, who, by the way, and this will resonate with a bunch of people out there, in this $4 million company, this business owner was making less than $75,000 a year. Now, they had put their blood, sweat, and tears and life savings. They went home to mama and said some 5 years ago, hey, I'm going to start a company. And by the way, love, I'm going to mortgage the house and I'm going to sell these other things that I own to be able to have enough money to open the company. Start to recognize the story that I'm telling here?
Yes, it's all too familiar with a lot of people. Keep going.
So getting to the point where the client had an understanding, first off, that it was within their control, right? This isn't something that happened to them. This wasn't some adverse circumstance where somebody had stolen money from them. This was solely created through the lack of control of both gross margin, net margin, and then more importantly, where we started our conversation today, cash is king, right? You have to be able to have cash flow to be able to service your obligations. All of your cash flow is generated through managing profitability, right? And then that cash flow needs to be earmarked to what, and I hope I don't throw a bunch of people off, there's a difference between a profit and a balance sheet transaction, right? Balance sheet is dealing with what you owe and what you own, right? So there's cash transactions that happen in a business that are only able to pay because you generate enough profit in what you're being able to produce. So I don't want to, you know how me, Mike, I'll jump out there and do a full-on geek out session with you, put me in front of a whiteboard and we'll have a great time. But hopefully I covered that with enough understanding. If you want me to delve into it a little deeper, I'm always careful not to go down rabbit holes in our conversations.
I do have a question for you about something, because you'd mentioned managing your growth. Are there any telltale signals that you're not managing your growth as effectively as you could? Because just letting it go unbridled can put you into a big bind, as you just discussed. But there's got to be some telltale signals that, you know what, maybe we better pay more attention to how we manage our growth rather than just do the best we can to grow as fast and as hard as we can. Because that's where we get into trouble.
So one of the first things I teach is profit is engineered. It's not something that's residual. If I know that I'm in a $2 million company and I can engineer through good business behavior 10% profitability, that gives me $200,000 worth of liquidity from my performance of my business. Well, if I've only got $200,000 left over, now I need to decide first and foremost how much of my obligation is going to be Uncle Sam's. Right? I have an aggressive tax minimization strategy. I've gone through good corporate structuring. I know whether I'm filing on accrual or cash basis, but I've been able to discern that this is what, within a margin of acceptable error, this is what my taxable obligation is going to be. The next part of that is you've got current portion of long-term debt, right? Because that's your real cash obligation, is your current portion of long-term debt. That's what I'm going to pay this year. And then lastly, I have to look at receivables. So now I am going to geek out on you a little bit.
Okay.
If I have 40 days of average receivable in a $2 million company, the way you figure out that you have 40 days, because your accountant comes in and tells you, hey, you're running at 39 days receivable or 45 days receivable. I go into clients all the time who will say, well, yeah, that's what my accountant told me. The disconnect is they nod their head at their accountant, but they really don't know what it means, right? So if I'm at 45, what did I say, 45 days of receivables?
Yeah.
Or 40 days of receivables? So I'm at a $2 million company and I want to figure out exactly how many days of receivables I have, right? Mm-hmm. It's a really easy math. If you take my revenue of $2 million and you divide it by 365 days, that's going to give you how much revenue you're generating every day. So I'll break out my handy dandy calculator I've got on my desk and I say $2 million divided by 365 days gives me $5,479.45. That's my daily revenue. Now, if I go over to my balance sheet and I look at how many receivable dollars are currently owed to me, right? So I've got a $2 million company. Somebody owes me $200,000 or a bunch of people owe me $200,000. That's what I've got on my receivable balance. If I divide my receivable balance by my daily revenue, it's going to tell me how many days of receivable I am now become the Bank of Rob. Okay?
Yep.
Now, you can play with that number a little bit, right? If it's 40 days, or let's just do the math. So I've got $200,000. Remember the number 5479? Mm-hmm. So $200,000 divided by 5479. In this particular illustration, I've got 36 days of receivables. Now, the interesting thing about this story is what happens if it's not 36 days of receivables? What if it's 46 days of receivables? You got 10 more days of receivables. Remember that 5479 number?
Right, yeah.
Right? What is 10 times 5479? $54,749.
Right.
So just 10 days of bad receivable management in growth, right? Just 10 days cost you, the client, $54,000 called the Bank of Rob. That's where most people miss it, because if I'm a $2 million company at 36 days of receivables, right? Mm-hmm. That's $200,000. If I become a $4 million company with $400,000 of receivables, what happens?
Yes, you're upside down.
Now you're upside down. Now you're borrowing money to pay your bills because your receivables. Now, to be clear, Mike, 36 days of receivables is phenomenal, right? If you're in business and you can manage 35 to 39 days, it's outstanding. It's not what I normally see. Normally what I see is 50 days, 60 days. Then I'll have retainage where people won't get paid that last 10% until the job's been punched out. Now you got a cash flow nightmare. Okay, so when we talk about cash is king, remember that your business pays you back if you do the things to make that happen. Okay?
Got it. Good management.
So, yeah, it doesn't happen organically. It happens because we manage it.
That was a valuable lesson for everybody that was watching this video. I'm sure that there's a few people have not thought about working the numbers that way so they get a better sense of reality and they can react quick enough so that they don't go upside down after 4 or 6 months of letting that happen to them over and over again. And then all of a sudden they get a big scary statement at the end of the year going, this is where we lost it.
I've got a lot of very talented, very mature businesses as clients. Mm-hmm. And I will tell you, even the most mature businesses, for any one of a number of 1,000 reasons in the conduction of business itself, you're going to have stressors on cash flow. Okay?
Yeah.
So don't think when you're listening to this dialogue today, and I went through some pretty rudimentary principles, that you can't take a $20 million company and uncover those same impacts to cash flows, because it happens in the most mature companies. So I don't want to sound like I'm talking down to a small business owner. That's why I'm in service to them, right? I believe in the small business community, Mike, you know that, mm-hmm. right? It is critical, whether you're a $2 million company or a $50 million company, that we stay focused on the fundamentals. Cash is king. Right? It's generated through engineered profit and managed to your balance sheet.
Brilliant. Rob, that's a great lesson for today. Thanks for being on the show. Unless there's anything else you want to bring up.
I will say Merry Christmas. I will say a Happy New Year. You know, Cogent Analytics exists, Mike, because of my passion for the American small business owner. Give us a ring. Go to our website, cogentanalytics.com. Right, sign up for a discovery. It's a 2 to 3 day process. We take a holistic approach towards your business. That's business development, organizational, process engineering, and control systems that you've designed and developed. And what I would say to all your listeners is don't let your personal pride get in the way. Invite, whether it's Cogent Analytics or someone ethical and honorable like us who want to pull apart and look at your business in a holistic way. Do yourself a favor and uncover every area of opportunity. So again, cogentanalytics.com, www.cogentanalytics.com. Sign up for a discovery, right? We do a very, very comprehensive review that's supposed to empower you and your team to know where your landmines are. And with that, I say Merry Christmas, God bless, and a Happy New Year.
Thanks, Rob. Merry Christmas to you, too.
Merry Christmas, Michael.
All right, you've been watching CEO Money with Michael Yorba. Thanks for joining with us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.